What happens when the most indebted global power demands that its closest ally inflict economic harm on itself? That's not the plot of a thriller, it's the real direction of US foreign policy in 2025. Recently, the US issued a stark demand to Japan. Either intentionally damage your own economy or we'll do it for you. As this drama unfolds, Toyota is facing losses of $1,300,000,000. Japan's GDP is shrinking, and Washington is pressing Tokyo to raise interest rates, a move that could trigger chaos in Japan's bond market. Why? Because the US is trying to protect its weakening trade position. This comes at a time when America is attempting to offload $22 billion, 0 cents, in long-term debt, only to find global investors walking away. While Washington pressures Japan to comply, Tokyo is preparing a countermove that could catch the US off guard. And if they follow through, this won't be a simple tariff dispute, it'll be a power struggle. Japan's economy is under severe strain, with debt reaching a staggering 1.3% of GDP in Divan Aribo, the highest among developed nations, per the IMF. Despite Japan entering recession, the US Treasury is urging the Bank of Japan to raise rates and strengthen the yen, putting even more pressure on Japan's already fragile recovery. This is less about cooperation and more about economic brinkmanship. Treasury Secretary Scott Bessant is advocating for monetary tightening even though Japan's inflation stems from global shocks, not overheated domestic demand. Why would Japan sabotage its own growth just to prop up the US? Toyota alone lost 180 billion yen in just 2 months due to a 24% auto tariff imposed by the Trump administration. The company now expects a 20% profit drop for the fiscal year ending March 2026, a direct hit from US trade policies. But instead of easing up, Washington is tightening its grip, linking tariff relief to Japan undermining its own export competitiveness. Japan, which sends nearly 20% of its exports to the US, is feeling the squeeze. However, Tokyo is beginning to explore alternatives. One potential game changer, adding China and Taiwan to the CPTPP trade agreement. This would shift the Pacific trade balance and potentially challenge US dominance in the region. Meanwhile, the US is about to test global confidence in its finances with a $22 billion 0 cents auction of 30-year bonds. Investor participation is falling, domestic interest has dropped to 14%, and long-term inflation expectations are above 3%, well past the Fed's 2% target. If foreign buyers, especially Japan, one of America's key creditors, retreat, it could signal a breakdown in global trust in US debt. The June 2025 Treasury report openly called for the Bank of Japan to support a stronger yen as a tool for trade rebalancing. But BOJ Governor Kazuo Ueda remains wary, pointing to weak wage growth and a drop in household spending. While a stronger yen reduces import costs, historical data shows that it does little to stimulate consumer demand during downturns. Deutsche Bank estimates that achieving US trade goals would require a 20 to 25% yen surge, a devastating blow to Japanese exporters already hit by tariffs. The US negotiating team, made up of Bessant, Commerce Secretary Howard Lutnick, and Trade Representative Jamison Greer, has shown disunity, further frustrating Japanese officials. With no clear US position, talks have stalled, leaving Tokyo guessing which demands are actually non-negotiable. As the US team heads to London for talks with China, Japan isn't waiting. Exports to CPTPP countries are up over 13% year over year, and companies like Toyota and Honda are expanding manufacturing in Mexico and Thailand to bypass US tariffs. Mitsubishi is also securing rare earth supplies through Vietnam and Australia under CPTPP and RCEP frameworks. These aren't just tactical moves, they're signs that Japan is building an escape route from US dependency. But can this strategic pivot truly replace the scale of the US market? And how will Washington respond once it realizes Tokyo is shifting away? Investor sentiment toward long-term US debt is deteriorating. In early June, 30-year Treasury yields hit 5.12%, the highest since 2011. Foreign interest in US debt has dropped sharply, especially among Japanese pension funds, now favoring euro-denominated infrastructure bonds to avoid dollar risk. Inflation expectations are now at 3.1%, a clear signal of skepticism about America's fiscal trajectory, Dabit's CAONs. Trump's tax reforms are expected to add between $2.40 and $2.6 trillion, 0 cents, to the deficit over the next decade. The Congressional Budget Office projects U.S. debt could exceed 121% of GDP by 2033. Yet, the U.S. still relies on foreign capital to fund its current account deficit, which now stands at 3.8% of GDP. So here lies the contradiction. The US wants to bring manufacturing back home while still depending on foreign capital, but without sustained foreign investment, the dollar could collapse or the debt spiral out of control. Inside Japan, resistance is growing. A May 2025 Reuters survey found that 68% of Japanese economists oppose interest rate hikes until the trade outlook becomes clearer. BOJ officials are even considering postponing bond purchase reductions as yields climb to levels unseen since 2013. In the background, Tokyo is drafting plans to include Taiwan in the CPTPP, a move that could redraw Asia's trade map and provoke strong reactions from both Washington and Beijing. Japan is signaling it no longer wants to be a passive participant in US monetary policy. But what if Tokyo goes further, not just rejecting American pressure, but actively reshaping the global trade architecture? With China eyeing the CPTPP, Taiwan preparing to join, and the US entangled in its own financial chaos, Japan might stop asking for approval altogether. If America loses Japan as a financial partner in Asia, the consequences could be vast, from rising bond yields to fractured alliances and a fundamental shift in how global markets assess trust. So the question becomes, if Japan walks away, who steps in, and what if no one can?